This is the New York Fire Department Pension Fund Investment Meeting. Today is 6/20/2012. The time is about 6 minutes after 10. We're in the New York City Comptroller's Office, 1 Center Street, room 1117D, New York, New York. Roll call of trustees, please.
Roll call of trustees. Ms. Ranji Nagaswamy.
Ms. Emery has Ms. Nagaswamy's
I'm sorry, I can't hear already. I'm sorry.
I just said that I have Ms. Nagaswamy's proxy. Janice Emery.
Thank you.
Mr. Larry Schloss.
Present.
Ms. Janice Emery.
Here.
Mr. Steve Cassidy.
James Slevin has Stephen Cassidy's proxy.
And Mr. James Levin.
Here.
Mr. Robert Straub.
Here.
Mr. John Kelly.
Present.
Mr. James McGowan.
Here.
Mr. John Dunn.
Here.
Mr. James Lamonda.
Present.
Mr. Sean O'Connor. Commissioner White.
Present.
We have 23 and a half vote in a quorum. We can start the meeting.
So now we're going to start with performance reviews.
Yeah, I'd like to try something a little different today. Last month we did the March numbers. Then we're going to do the April
I'm
numbers.
sorry. I'm still having trouble.
Sorry.
I'm sorry. I don't.
You may move over a little bit because he's going to talk a lot.
Okay.
But wait, Larry's going to talk a lot, so
I'm going to try not to talk a lot. Less is better.
it might be easier, to.
All right, so don't get upset if I trim
I
this
don't
one.
want to.
Okay.
It's my good side.
No, it's not Larry.
The other. Or I don't have one. You want to sit in the middle? Let's do that.
I think that probably would be better. I'm going to have to move all of my things.
Okay.
Thank you.
Coffee break. Make a restart.
So Martin's so joking.
I got that joke.
Martin, you should sit near her or something. Yeah, so, okay, so she can definitely sit.
Already been trying with this.
Disconnect anything because I'll have to start over. So if you can move the machine, that'll be good.
Larry, first question you came up, we had a long meeting today, right?
Yeah, I'm going to try to be short at the beginning. I mean, it's one of these, it can be long as you want. We said that. We're really quick, man.
We don't want long. Is that right? Yeah, we want clarity. We're fiduciary, so we want clarity. No. We're on camera, right?
I think we can do the session now for 4 hours. The executive session for 4 hours.
Is it okay?
Some Johnny Carson jokes.
Thank you. Okay, thank you. Okay, thank you.
You ready?
Yes, I am. Thank you.
Okay, Larry.
Okay. So last month we went through the March results. This month we're going to go through the April results. All hell broke loose in May, and now we're in June. So to spend a lot of time on the third quarter results seems like not only the horse left the barn, but we left the barn, had lunch, and came back. So I'm going to try, with everyone's agreement, to have everybody go as fast as possible through the quarterly results, because again, the good stuff, or not good stuff, the real action is in the fourth quarter, not the third quarter.
Third fiscal.
So Martin, why don't I hand over to you with that little premise?
So as Larry mentioned, the world of the quarter ending March had moved on, and the world for the quarter ending March was a good world. If you turn to page 8, We have the total,
Page 8 of the quarterly.
page 8 of the quarterly report, we have extra copies if you don't have it. Not the color book, this book here. It's on the bottom, yeah.
Do I need one? Fire away.
So on page 8, on the left, we see that the quarter return was 811, very strong performance, ahead of benchmark slightly. That brought the fiscal year-to-date and one-year numbers up to positive territory, although it's behind the benchmark. You'll see the three-year number was a very strong 1751 on an absolute basis, although that was behind the policy benchmark. The reason it's so high is because the quarter ending December of 08, which was the really bad quarter, rolled off the three-year number. But when you look at the five-year number, it's still in there, and that's why it really drops down. But it's still now a positive number, in large part because of the good quarter that we had in March. Unless you have any questions about that, I'm going to turn it over to
Okay, thank you, Martin. If you turn to page 21, this shows the domestic equity allocation for the fund. And as you will see there in the pie chart, about 70% of the fund is passively managed, the rest actively managed. And I'll just point to a few columns here. The index return, the actual return, and the difference column. And what you'll see is in the index return column, you can see some very strong double-digit returns for U.S. equities in the March quarter. And I'll just point out that the mid-cap, which is up 13.5%, was the strongest of the group, but small and large cap are also up strong double digits as well. That's centered around more optimism about Europe in the quarter and U.S. employment numbers. And a couple of your managers, if you just look in the difference column, under mid-cap active outperforming by over 300 basis points, and then there's also 1,000 active outperforming by over 200 basis points. So the mid-cap active manager is Wellington for you that did quite well, and in large cap, Aronson Johnson did quite well. If you then turn to page 28, this goes through the international allocation for fire. And you'll see here just a bit of the reverse in terms of active versus passive split versus the U.S. So 76% of the money is run actively in international, the rest passive. And again, I'll point you to these several columns: index return, actual return, and difference. And here you can see the last row, the emerging markets, up a very strong 14%. The EFA markets as well, which is, a big chunk of it is Europe, up over 10%. So again, a strong quarter. And what was really happening then, you might remember, is there was more certainty about the Greece bailout, the euro strengthened, and just the opposite for most of the June quarter, which we'll go through September, I guess. And just to point out one area, so non-U.S. activists, you can see in the difference column, outperforming by over 400 basis points. Very strong performance from governance for owners, which is one of your managers there. And now I'll turn it back over to Mark.
Thank you. If you turn to page 39, your largest fixed income program is the investment grade 4+5 program. Page 39 breaks down on the top in the pie chart where the assets are invested in which of the three main sectors. If you look at the over and underweight in the chart on the bottom, you'll see we were underweight treasuries and overweight mortgages. We later added moved some money into the underweight investment grade credit. The reason why it was underweight is because of the issuance dynamics between the different sectors. The good news is that the underweight in treasuries and agencies held because risk was back on in the quarter, and so treasuries and agencies had negative returns, and the other spread sectors had positive returns. In addition, in the difference column, you'll see that there are positive numbers there. Overall, including all the retirement systems, we have 13 managers. 12 of the 13 managers outperformed during the quarter. So it's good news all around. So if you look at the returns on page 40, while they weren't as strong for fixed income as they were on the equity side, they were still positive. Returned 1.03%, ahead of the benchmark for the quarter. And the fiscal year-to-date 12-month numbers are also very strong. The 12-month number is over 9%, 11 basis points behind. And the 3-year number is over 9%. And even longer-term numbers are either over 6.5% or over 7%. I do want to point out at the bottom where we have the volatility has actually died down a bit. And so volatility typically is 4 to 5%, so we earn the 9% return on 3% volatility, which is pretty nice volatility to earn that return. A couple of other points I want to bring to your attention. On page 42, you see enhanced yield, which is tied to correlations in the equity market. So enhanced yield did well. It was slightly behind the benchmark. We know we did search for high yield, so that the manager mix will be changing over time. Longer term, the results are well ahead of benchmark. Shorter term, they're behind the benchmark, but are positive numbers. And the 3-year number is extremely strong at over 18%, roughly matching the benchmark. My last comment is on page 43. We will be talking about convertible bonds more in the executive session. I said that high yield is strongly correlated to the equity markets and have good return. Convertible bonds are even have a higher correlation to the equity markets and therefore had a higher return, although it was behind the benchmark. And the strong absolute return brought the fiscal year to date close to the even line. It's now down by 39 basis points, and the 1-year number is down by 104. The 3-year number you see, while strong, is behind the benchmark. And again, we're going to talk more about this in executive session. My last comment is about opportunistic fixed income on page 44. The returns that you see here are versus the 10% return as well as the global benchmark plus of 3%. We're sort of at an inflection point in opportunistic fixed income. We have some managers that are rolling off, like PIMCO Disco and some of the Avenue funds that are in distribution mode. But we're also, as you know, funding and have hired managers for strategic mandates where they can pull capital when the opportunity arises, like today. So we're expecting, and we're about halfway there on a committee basis. So we expect that the opportunistic returns will start reflecting the new strategic relationships going forward. But for the period that you're seeing here, it mostly reflects the managers that have slowly gone away. And I think Kathy's next.
Yep, I'm here. Good morning. Your ETI portfolio on a net basis. It's there? Okay. Okay. On a net basis, performed neck and neck with its custom benchmark, which is what we would expect from this portfolio. So there it is. And then on page 7, as always, in the large agenda package book, you can see where your investments are having impact in the 5 boroughs. We continue to make new commitments and purchase new loans. Activity goes on. Are there any questions?
So next is private equity. So I'm going to touch on in the color flip book, page 57. That's actually the other book. This one here. I'm going to touch on one page, which is the contributions and distribution page.
I won't catch up.
Hold on a second, just a second, please. 57 in
57 in the color flip book. The monthly book. Correct. So, as what you notice here, in April was the first time in calendar year 2011 that distributions outpaced contributions, so clearly moving in the right direction. That being said, one of the things you'll notice here in the previous months, there were significant contribution amounts. That's really for 2 reasons. One is, as people remember in the past, we've made significant commitments to the asset class recently. So as a result, as those continue to get drawn down, you'll see an increase in contributions. The second part here is in the marketplace today. The distribution pace just in general has slowed down. So while we have moved positive for April, directionally for May we're roughly flat. As we look at where we are today, contributions again have increased past distributions. Only other contributions have increased above distributions. The only other comment I would make is that since inception to date, IRR is 10%, so that's a solid return and continues to move in the right direction as well. If there are any questions, I can take them. If not, I can turn over to Yvonne.
So, we have the same graph on page 59.
I don't know
Oh, can you
what to do with it. It is kind of hard to hear.
Thank you.
It's a lot of...
So on page 59, we show the same activity for the real estate portfolio. And in this April monthly book, it indicates a market value for the portfolio of about $250 million. Similarly, if you look at April, you will see that it peaks downward, meaning that there were money going out to the managers, a significant amount, about $24 million going out to our managers in response to about 12 capital calls that we received during the month. So prior to this time, the demand for capital from us has been relatively quiet. We take this peak to mean that our managers are seeing some clarity in the market in terms of pricing, and they're putting our money to work. So in all, we have 27 managers, 37 investments, and they're actively working to deploy capital in real estate. So does anyone have any questions about real estate at all? We're going to have some further discussion on European real estate trends later in the Thanks.
Okay. That's the old quarter. Let's move into the...
Larry, could I just ask a quick question?
Sure.
So there are performance attribution pages for, starts with the quarter ending on page 12. Page 13 is the 12-month attribution. You've got 3-year attribution on page 14. These books.
Yeah.
And the detail for the slippage in the management effect is actually provided to us on page 15.
Which book are you looking at?
In the quarterly book. So this quarterly book. So it's pretty easy to see on page 15 that the slippage in terms of manager performance has been private equity. And I think you're doing a lot of good things to make changes in that portfolio. I think we're also looking to change the benchmark at some point because that might be an aggressive benchmark for us. So it's pretty easy for me to understand where the negative, 0.66 has come from over the 3-year period on page 14. What I don't understand is where the negative 1.56 is coming from, also on page 14. The difference between the 17.59 and the policy index of 19.81. And it's the same for the other pages as well. And that's a pretty big difference on a 3-year period. And
Let us see if we can get some information.
okay. Do you know, certainly that would be good to have going forward, but that's a pretty big difference, and we haven't really touched on it.
We will, without getting the exact numbers, we should have a number for you for September meeting for the fiscal year end. We're working with the bank on that to mirror that.
Okay.
So maybe we can spend some more time understanding that when we have this.
Sure, let's get the information. Okay. Moving to April. Yes, so we have April, May, and we're halfway through June. And what basically happened in the fourth quarter of the fiscal year is events in Europe have overtaken the markets. So the quarter ending March was a good quarter because it was relief from the events that happened in the second quarter, which was primarily the LTRO, which was the ECB, the European Monetary Authority, is having these 2 tranches of short-term loans to banks. About $1.3 trillion. Everybody breathed a sigh of relief. Then the markets went up in January, February, March. And then in April, people started to worry again. Well, there were some elections. There was an election in France. And there was step 1 of an election in Greece. The French one was relevant because in France, you had a shift to the socialists, and the result was the French, who were sort of the one partner of the Germans, decided we don't like austerity anymore because austerity is painful, so they brought about the austerity people and they brought in the growth people, which can't change policy on a dime, but it did change the discussion and initiate the discussion. At the same time, you have Greece, who would cut a deal in the fall to get relief from its bank arrangements. So Clevered had step one of an election. And again, the far left came in second, leading for growth as opposed to austerity. You had sort of made everybody very, very anxious. So we go through some April numbers, pretty common, and we walk through some May numbers, which are not common at all, and then things very much lifted. Spain getting a bailout, Spanish banks actually getting a bailout last week, and then the Greek elections over the weekend. And then the short of it all is that any semblance of value or equities for value or bonds for value has been thrown out the window because everything is about prices. So the markets are just gyrating up and down. Europeans are being very, very slow. Background, you have the U.S. economy, growth rate slowing down from 2.5% to about 1.9%. Unemployment starting back up again. So unemployment is now picked up from 8.1 to 8.3. The election, the U.S. election, the background in November, and then you have this thing called fiscal cliff in December, which is the expiration of the Bush tax regime and the debt ceiling. All of that is a way of saying the markets have gone back to being higher volatility, lower returns. We're long-term, we're repositioning our portfolio for the asset allocation that we agreed to last June. Got the adjusted ranges in December. So trying to sort of change direction a little bit, very, very high seas, a little problematic. But I think we're going to end up all right. We're all said and done. So if I can get you to turn...
Before you start, Larry, I just want to point out that Christopher Barrett is present in the meeting now.
So I guess if I can get you to turn to page 22. The volatility is measured by VIX. U.S. equity, you can see it picking up again. And then if you jump to page 24, the white line is the U.S. Treasury curve. What's happening is when people get very, very anxious, they rush to the U.S. Treasuries. The U.S. Treasuries, the rate may early June, the lowest ever, 4.7 or something, which is a ridiculous number for a 10-year bond. But it's 100% fear. The interesting thing is the fear hasn't even happened yet, so just going to show you how prevalent fear is. You can see it really pictorially on page 25. Again, see with the 10-year note it's done. Again, it reached 1.5. It's now at 0.62. Again, very, very low levels. 26. Very short slide. Your bonds backing up. Investment grade debt backing up a little bit. You can see. Sorry. You can see on the other hand on page 26, U.S. corporate profits continues to reline, continue to expand, but the problem is all this uncertainty has made U.S. companies not know what to do with money. So that means they do nothing. Doing nothing is bad for unemployment, it's bad for construction. If I can flip it back to the one chart that we're talking to all the time, it's forward-looking, which is page 10, which is architectural billings. Remember, the last couple of months we've seen it go flat. Again, to hire the architect before you break the ground, I would say, the architect before you actually start to spend a lot of money. For the first time last month, we went below 50. 50 is the number for the dividing line between growth and contraction. So it went from sort of meandering around 50 to below 50. This is a bad thing. It means, again, people are pulling back their planned construction because they're just not quite sure what's going to happen. And again, I say that this not quite sure what's going to happen is going to continue until we get our presidential election. So So you're going to have muddle for the rest of our year. Not good for average parents because you're going to have doubts of what I'll call anxiety. Page 31.
Larry,
Yes.
before we get past it, on page 9, consumer sentiment
Yeah.
is way up from September.
Yeah.
So in spite of everything, I mean, that's a good indicator, isn't it? People have money to spend and they're feeling good about things, and
I would tell you that consumer sentiment is unreliable.
okay.
I'd also give you a little historical. This goes back 5 years. If you go back before '07, you go back to the good times in '04, '05, '06, you're talking about numbers way over 100. Yeah, they go back, numbers are way over 100. So this is compared to the lows that we reached in '08, the problem that we had when we rebounded off of that. This is still historically a low read.
Okay.
So you say consumer sentiment at that time was over 100?
Consumer, I mean, just agree with you a little bit. The consumer sees, if the consumer has a job, to start there, right? The consumer seeing currently is the price of oil going down, right? So you see that at your gas pump, so you feel better about that because your paycheck goes just a little further. That said, if you just go to page 15, you'd see all of that go up, and if you were so excited you buy your car, just buy your car. You're also not buying new houses. So, I mean, what the consumer sentiment number shows you, and what the economy is showing you, which is, you know, maybe consumers feeling better for whatever reason. Maybe they have a job and they're happy just to have a job, but I wouldn't draw a lot of consumers from consumer sentiment. If it goes down, that's a bad thing, but the fact that it drifts up, Mark's point before, they'd be a lot happier than just now.
Thank you.
So let me jump you to page 41. So again, we had a very good first quarter, up about 8%. And then in April, people started to worry about these elections I was just talking about. So the markets really didn't go anywhere. It drifted. So again, if you look at the far left-hand column, the first block of numbers, the U.S. stock market kind of, down a little bit. International markets down 1%, 2%. High-yield bond market up 1%. The problem was in May, you had this French election. You had a conversation about the brief elections from phase 1 where the social distancing came out. And that gets you to phase 42. Page 42, the stock market, the U.S. stock market went down 6+%. ETH went down to 11. And emerging markets went down about the same. High yield market back up as well. So again, we're looking at April numbers, which are basically irrelevant now because we lost money in May, and I'm going to tell you what happened in June. But again, so if you go to page 33. This is the monthly progress of the pension fund. So the $8.2 billion after May, these are some numbers to write down, it went down about 6% in May. So call that $7.7 billion plus or minus. And in June, finally we got through the Greek election last weekend, and people feel better about it the week before, we're up about 4%. So as we sit here today with 10 days left in the month, we're sitting right on where we were at the beginning of the year. Right, and I have no idea what the next 10 days are. I'd like to be optimistic. If it goes up a little, maybe it goes down a little, hopefully there's no big problem. But, if we get out of the year with making some money, I would say we declare victory we want the next fiscal year. But again, it's not an 8% year, it's not a 7% year. It's been a very, very difficult year for the investor, but we'll see how it all sorts out. So with that in mind, if you go to page, again, these are old numbers because of what happened in May. Let's just go to April. Page 43. So again, U.S. markets were down a little, bond markets were up a little, so we were sort of flat. Right? The first column on the left was flat. This year to date, coming into the day, we're up about 3%. May we're down again 6. June we're probably up about 3, so we're kind of coming back to where we started from at the beginning of the year. Also, an awful lot of gyrations in the middle. What we're going to try to do in the next board meeting is sort of give you a flash year review of the things that we did, things we didn't do, where we made money, where we didn't make money. So, I can say this early, it's aggressive as chart. If you have any questions on the old news, happy to answer it. More interesting is what happens in the next 10 days and beyond.
I'm sorry.
It's more interesting to see what happens in the next 10 days, because again, the number that matters is the fiscal year-end number. But I think we're reasonably well positioned for what may or may not happen. I feel reasonably all right, I guess, about the next 10 days, but we'll see. In the next 6 months of the year, I think is going to be more of the same, which is a very volatile period of time waiting on Europe and then waiting on the United States presidential election. So it's a difficult time to make a lot of money. Hopefully we don't lose a lot of money as well. So unless you have any questions, that sort of ends the April discussion of results.
Larry, on this page 43 that we were just looking at,
Yeah.
is there a box here for cash? Whether it's cash helped over these 20 years?
I guess not.
Well, this is being the contributions return, cash being roughly 0. The number would be a very, very low number, certainly less than 10 basis points. What this chart shows is each of the asset classes' contribution to the overall. So it's not an overweight or underweight thing, it's the actual contribution. So this would, whatever the cash number, we didn't have the cash number in, but whatever the cash number is, because cash is so low as return, it would be a very, very low number, probably maybe less than basis points.
That's just going to look for this year, no matter how much you cash or cash, it's going to be
I'm just getting back to attribution and trying to understand where things helped and hurt. Since we were carrying a pretty high cash level for the past, well, certainly last year and even beyond that, I'm not sure I see the effect of that here.
No, it's not the chart.
That's what we're working on with banking.
And PC, I don't know if there's anything that you provide to your clients that, not looking for duplication, but is there anything that's complementary that you guys can provide to us to help us better understand attribution?
Yeah, we absolutely can. I think when we get the fiscal year quarter number in, we can bring in our charts to complement what BAM is doing with Bank of New York. But I think an important point will be to talk about methodology and how we're handling the conversion from the old policy to the new policy, or whether we're using the adjusted policy. Your question before from the quarterly report, I think that's going to be key, is to, you've got some asset categories like private equity, where we've bumped up the target and we're still underweight. Real estate, we're still underweight. And over a 3-year period, those categories have done well, and the private equity number, because we use the market benchmark plus the 5%, is going to be probably the highest returning 3-year component of your, what we call an allocation index, which reflects your overweightings and underweightings, that we compare to a policy index, which is your, in a perfect world, if we moved all our money from one policy to the next policy, or even if we did it in increments, that's capturing that return. And the difference is that we call it an allocation effect, but I think in the book it was called, it wasn't called a management effect, it was called an allocation effect.
Because I totally agree with Larry that looking at this one amount of stuff, it changes so quickly, it's not really helpful. I'm thinking we need to really focus on where we've done well longer term, where we haven't done so well, and sort of understand and use that. And also, it looks like we've got a 1.7% cash level, which I'm curious about, because now we've figured out parking places for all of the money that we're supposed to be investing over the long term, so I was a little surprised to see cash up around 2%.
You said it was temporary, and then you said something else.
Just temporary, moving the allocation around. Got some RFPs that we're filling.
Also, a 0% cash level will actually be something near 1%, simply because we need money to pay benefits, to pay taxes, to pay other things, and withholding taxes, to pay other things during the course of the year. So there will always be some frictional cash level that will approach 1%. Based on the level of taxes.
Any more questions from one?
Yeah, the BSF.
Do
BSF first?
BSFs are at. Okay. So we had, as you know, we made commitments to the Blackstone Real Estate Fund, as well as Brookfield, both of which are global in nature with definition of global as a substantial portion, well, that's a significant portion of the So we thought it would be useful to have our view from a couple of people, one on consultant, one on manager, on what's their view of what's going on with the real estate market. So we have to get into this for education purposes. Patients and everyone.
As close as possible to where you go.
So we got a lot of background noise, and she's the most important person.
As soon as you get settled, just state your names for the record. Proceed.
Hi, I'm Tal Bojani from Cohen and Steers. I am Nicholas Cooper from the Townsend Group. The Townsend Group.
Cohen and Steers is one of our REIT managers, and Cohen and Steers is one of our managers, our REIT. And Townsend is our advisor, real estate. So there's a good balance between investor and as well as advisor. So you're going to go first?
I'm going to go first, like I did 2 weeks ago. Wait 1 minute till they're handed out.
Let's start in this book.
Good, how you doing? Okay, well, good morning, everyone. Thanks for having us in here to talk about the European markets. We are, as it was described, a fund manager for the city from the equity perspective. So I'll talk about Europe more so from the equity side. I think Nick will take more from the debt side. But if you want to start on page 2, we have a presentation. We'll kind of use this as a roadmap to talk about Europe. I spoke about Europe 2 weeks ago, and I sit here today, and a lot of things have changed, and I think, that's the important thing to take away, is that things are changing quickly, and if I come 2 weeks from now, we'll have a different outcome as well. But the general conditions in Europe are challenging. Obviously, northern European countries have more stable economies, albeit while not growing, more stable, and the periphery countries are certainly having their challenges. Like when I was here 2 weeks ago, we were waiting on a Greek election, a second election. It seems like we've got a government being formed there that is pro-austerity. That will be good. There are a lot of things still to be resolved in terms of Greece, but now the attention has moved to Spain, and what are the likely outcomes there? And we've had a number of events in the last week or two where Spain has asked for more funding for their banking system, and we believe that that funding will create some stability, but is not the end-all, be-all. There are still many things to be resolved in Spain. In Germany is really the key to Europe right now. Merkel is being very tough on austerity, and before Germany is willing to provide more funding, we need to have better fiscal controls. And until we get there, they're going to continue to be challenged to meet their austerity needs. We talked about the political risks. Greece was a big part of that when we talked 2 weeks ago. We have some resolution. It doesn't change things dramatically, though. Greece still needs to work on its austerity. We have a new president in France who is more pro-growth versus austerity, and we're seeing some tensions amongst leaders there. This chart talks about GDP in Europe. As you can see, it's gone from growth to no growth or a recession. Our view for Europe is that we are in a recession, and we will have minimal growth in 2013. The northern countries will have better growth. Spain and Italy, Portugal, etc. will have slower growth. So what's the economic landscape for what we're calling the northern countries on the next page? Germany, France, and the United Kingdom. Obviously, Germany is the strongest. They have record low unemployment. The last 12 months, it was just about 4%, and their main source of GDP growth, exports, continues to be strong. As we get to France, we have a new president, not prime minister as we have in our presentation, unless maybe we fix that in the copies for today. As I said, he's pushing more for growth versus austerity. GDP was relatively flat for the first quarter, but we expect that to moderate from here. We have a country that continues to suffer from a weak manufacturing and high unemployment. As of the end of the first quarter this year, unemployment was about 10%. That's up about 3% from last year. The UK obviously is independent from a monetary standpoint from continental Europe. As of this morning, their Fed said no more quantitative easing. I think the market was looking for more money to be put into the system, and I think there are questions about the efficacy of the austerity measures that they put into place, and whether or not they're meeting the goals. As we move forward to the property markets, I want to make the distinction between what's happening in the property market with really what's happening with the economies. We are in a low interest rate environment, and that's supportive of prime pricing. There's been a number of transactions more recently in the market, that suggest that values are stable for what we call prime assets. Those are assets that are newer in age and tend to be in what we call supply-constrained markets, kind of central business districts or in dense population areas. If you look at the underlying fundamentals for those properties, they're generally okay. We're not seeing high levels of vacancy. We're not seeing a lot of rent declines. But there's not the tension that you see in a more healthy environment where you have more economic growth and more employment. One of the things that we like to look at is what's that spread between where you can borrow money and the return that you get for real estate. And that spread's relatively wide today. That means positive leverage when you're buying real estate. And when you look at values in Northern Europe, they're trading at wide discounts relative to the assets. And what I mean by that is the equities are trading for less than the value of the real estate. And those are historic wides right now in these regions, Northern Europe. We think that the stocks are trading at 10% discounts to the underlying value of the real estate. And as I just said earlier, we're seeing transactions happen in the market that are giving us confidence to our underwriting of the real estate values. So we think from an equity perspective that it's a good time to be owning more of Europe. And as I was saying a couple of weeks ago, and I still firmly believe today that, as an equity investor, we've taken up our weighting into those Northern European countries in terms of owning those stocks. We're still very cautious on the peripheral countries. I think there's obviously the cost of capital in those markets. If you have 7% debt yield, 10-year debt in Spain and 6% in Italy, they're facing some challenges, and that will ultimately affect some of the real estate valuations. Just to give you a quick snapshot into the markets that we like in Europe that we're investing in, we like Germany. It's obviously the strongest economy in continental Europe. We like the residential market there. We think that there's good opportunities for the public companies to consolidate that in the public markets. It's a lot of state-owned. We think better management, a better cost of capital, and we think that rents that can rise. In France, we're very focused on companies that own prime, and we think that a company like Unibail, which is the largest mall company, who has a tremendous balance sheet and can borrow money at less than the sovereigns can borrow money, is using that cost of capital to go out and make acquisitions, which is adding to their asset value and adding to the underlying fundamentals. And in the UK, we do like what we call prime London properties. That's central business district, office buildings, and some prime retail. What's unique about this economic environment is that there's not a lot of lending. Nick will get into that. There's not a lot of lending for the private side. There's lending for the public companies who have strong balance sheets, but if there's not lending, it's going to really eliminate that new supply that can occur in an economic recovery. So we think that you're going to be in a low supply environment, which is going to keep rents very stable and occupancies rising modestly in some of these more stable markets. Just before I turn it over to Nick, just to wrap up on page 7, our base assumption is that, basically the ECB, in combination with the sovereigns, will find measures to prevent a breakup of the core European market. There's a lot of acronyms that are getting thrown out there. Long-term refinancing, ESM for stability mechanism. So we think a lot of these things are going to be put in place in order to refinance Europe. That said, we wrote this probably about 4 weeks ago. We thought Greece was going to likely exit. I think the events over the last week would suggest that the new Democracy Party and the new formed government will most likely keep Greece in the Union. I can sit here and give you my views, but this situation it's without precedent. Predictions are in some cases speculation. What we try to do is probability weight the outcomes and manage that top down and a bottoms up when we think about investing in real estate. So it does get down to the asset level and what do I think those assets will do. We're going to be in a recession. There's no question about that. Some of that will cause deleveraging in the system. We know Europe needs to deleverage. I think that in some cases creates opportunity for the listed companies, but it also creates opportunity for others on the debt side. Valuations, as I said earlier, are cheap relative to the underlying real estate and in a historical context. And from our perspective, we think that's attractive. And then, restructuring is happening. You're starting to see some companies recapitalize themselves either by selling to stronger companies, but it's creating opportunity. So, our view is, the environment is challenging. The range of outcomes is very wide, but we feel like we can underwrite the real estate from a bottoms-up perspective and take a view from the top down. So from an equity perspective, we think there's a lot of opportunities. From what we see, we think there's opportunities on the debt side as well, but I think Nick is going to be able to articulate that as well. So let me turn it over to Nick.
Thanks very much, Tom. Good morning, everybody. As you can probably tell by my accent, I am a Brit, so don't hold that against me. I suppose I'm speaking about Europe as part of that as well. But as I said to someone else yesterday when I did a presentation, not only am I a Brit, but until she died a couple of years ago, I had a Greek aunt, and I also have a holiday house in Spain. So against that background, I'll give you my sort of insight as to how I see Europe. I've worked in this market for 30 years now. I think it's the most interesting, but probably one of the most challenging markets I've ever seen. And as Tom rightly points out, the macro environment is so unpredictable at this point in time. As I say, when we spoke a couple of weeks ago, we thought one thing was going to happen, something else has now happened. And I think you're going to see a lot more of that over the next couple of weeks. I won't pick up everything that Tom has said about the macro, but I will pick up a couple. For me, when I look at real estate and where I look at real estate investment opportunity, it's very often, I think, one of the metrics I always try to look at is employment and employment growth, or look the other way, unemployment. And it's pretty tough, as we've said. In Germany, it's 4 or 5% unemployment and probably will go lower at the moment. But contrast that with Spain, where you've got adult unemployment running at 24, 25%. You've got youth unemployment running at 50%. These are tough days. And austerity, however you want to describe it, is going to make it a very difficult landscape within which to work. And I've always seen employment as an important criteria because it either puts people in offices, it puts people in shops with money to buy, or it puts people in factories or whatever else. So always have that in mind, and that's going to paint a bit of a down picture. And as you'll see as I go through this, I'm a little bit negative. Well, I am negative. Not a little bit, I am negative. but I will also tell you that I think there's opportunity, and I'll show you that in just a moment. As well as talking about the macro side, I think there's one other issue that you do need to bear in mind when you look at Europe, and that's this regulatory side. The banking environment is being struck by something called Basel III, and I'll tell you about that in a moment. Basel III, and the insurance sector by something called Solvency II. And I'll explain how they come into play. But what I'm going to describe is almost like a perfect storm going on. So if you follow my presentation, and let's turn over now to what is page 2, what is all that macro that Tom has mentioned and what I see affected the markets? If you look at that top chart there, what you see is commercial real estate prices in the UK. They've gone down, no different to here, and they've come back somewhat, but they're still significantly below their peak value. Now, as a buyer, that gives you some comfort, but there's some value in there. The question is, where are they going to go from here? And I can see some weakness on the horizons, but the reason some of these prime assets that Tom talks about have got fully priced is because two things are going on. There's a flight to quality and a flight to safety, and no surprises there. In an environment as we see today, people are going to get attracted to good, solid assets. If you look at that bottom table there on page 2, you'll see that prime yields in some of those key city centres are now below their long-term average. And I think that's driven by two things. There's this flight to quality, this money focused there, and also the fact that we've got very low bond yields as well. So they can bond yields. I'll try and improve my English accent. So values are still a long way down. Investors are very focused on core. They're very focused on safety. And what we're therefore seeing is that anything outside of that little small area is becoming very, very difficult. And the effect of that is going to be in debt finance, as I'll explain in just a moment. But add to my perfect storm, if you follow me to page 3, this is two little anecdotes that I think are just worthy of noting. We all understand the economics of supply and demand. Put more assets to the market, prices will clearly come under pressure. The chart on the left-hand side shows you private funds. Unlike Tom's area of business, this is my expertise of business. There's a significant amount, there are about 95 private funds that are due to finish in the next 2 to 3 years. Now, in theory, those assets should come to market. They may well get extended, but in theory, you're going to add to supply. On the right-hand side is something called German open-ended property funds. And these really are where the private individual investor in Germany has used this as a means to invest. Now, unfortunately, these funds, which are technically open-ended, have not done what they said they were going to do. In other words, when you ask for your money back, they've not necessarily been able to give it. And the net result of that combination of problems is that we expect to see something like 20 to 25 billion euros of stock assets come out of these funds as they liquidate over the next period. So you're going to get this perfect storm that I'm building. You've got pressure on bank, you've got pressure on markets, you've got pressure on occupational markets. And you stand back and you go, okay, all right, how does that play out? Well, let's look at the last area. And Tom mentioned I would talk about debt. And on page 4, debt, in my view, is the key issue in the market. Most markets rely upon debt as a lubricant. That's what oils the market. That's what makes it move. take away the lubricant and the market starts to jam up. And you are beginning to see that today. There is a big difference between Europe and the US. 75–80% of all commercial real estate debt is held by the banks. And like here, where it's about 50–55, something like that. You have many other funding sources here. In Europe, you don't have that. It's all bank related. And we know you only have to pick the Wall Street Journal or anything else up and you see the issues that the bank has today. So that is going to create a problem. Around 960 billion of debt is outstanding today in Europe. Around half of that is due to mature in the next 3 years. Where's that debt going to come from? And that's the question that everybody's asking. If you're in these prime assets, that's fine, we can sort something out. If you're a REIT manager, you have a debt facility already in place. But for others, it's very difficult. And I will give you a very personal experience here. I act as a non-exec on a Middle East or an Arab bank property fund that invests for high net worth individuals in real estate across Europe. It buys good secondary. It has to refinance a property today in Brussels. The property has some vacancy on it. We have nobody to talk to. Nobody wants to talk. Not even at an exorbitant margin. Nobody wants to talk. You get to that position and things are going to get very difficult. That's a problem, but it's also an opportunity. And I'll show you how the opportunity comes in a moment. But put very simply, it's estimated there's around $225 billion of debt funding gap that has to be found in the near term. Now, it's got to come from in the near term. It has to come from somewhere. The question is, where's it going to come from and how's it going to happen? But let me just build the case for the bank. If you follow me to page 5, here's my theoretical European bank. You start in the left-hand side. 2007 was the peak of lending activity. But what we now see is fewer banks in the market. People like Euro, Hypo, people like Société Générale out of France have come out of loans. So there are less banks around. Do I think Spanish banks are going to be lending in the near term? I don't think so somehow. At least not. Maybe Santander might and BBA, but very few others. Values are still below peak. So they've not recovered their value, so there's a problem there. And here's where the regulatory issue comes in. If you hold a loan above 50% loan to value, if you have more than that, so 60%, 70%, whatever it is, from a regulatory perspective, the bank has to now provide excess capital on its balance sheet. Now, it's struggling to get that. We know that in the present market. So the net result is that the bank is going to try and shrink its loan book to 50% because it doesn't have to provide so much regulatory capital, which it can't get hold of. So those impacts, that Basel III, is going to be really important on the bank. Take the other thing of balance sheets, and I'll use my own country as an example. In the UK today, 60% of the commercial loan book in real estate is owned by the Royal Bank of Scotland and Lloyds TSB, or HBOS as they call themselves now. HBOS, sorry. And the third one is a group called NAMA, which is the bad bank for Irish debt. Between those three, they own 60%. Now, I, as a good UK citizen, own the Royal Bank of Scotland. I own a good share of Lloyd's. I don't own Norma. But you can see the problem. You can see where these loans have got to come out. The assets that support these loans have to come out. And I think that's what you're going to see in the next period of time. I mentioned on page 6 just something about CMBS, only because it's more known here. Commercial mortgage-backed securities is one of your funding routes here. Not really done in Europe at all. But it is indicative of the problem. Something like 18% today of all CMBS loans in Europe are in default. And that's up from about 14-15% 6 months ago. In contrast, the US is about 13. So the problem's going to get bigger before it gets better. So I think those are the big issues that sit around there. And you may stand back and go, well, that paints a pretty bleak picture. Why on earth are we even talking about Europe? As I say, I've been in this market for 30 years. I actually think for he who holds equity today, I'm assuming that's yourselves, this could be a very, very interesting environment in which to work. And I'm just going to show a couple of examples of where I think things are interesting. This is page 7. This is a student portfolio in the Blackstone Fund, actually, being sold today. Now, these are pretty good student accommodation, much better than when I went to college as a student, but these are in central London, Notting Hill, King's Cross, but both good recognised locations in London. The buyer can get a loan to 54%, but cannot get anything greater than that. And the opportunity was presented to fund between 54 and 61% in that debt. But the most important thing for me was it showed a cash return of 11.5%. Well, I get quite excited when I see 11.5% coming in, because I think that's not a bad return. On a risk-adjusted basis, I think students are still going to be there in the UK. I think mum and dad are still going to have to provide for them, but I think they're going to be there. And I think that sort of return looks interesting. Page 8 is a similar thing. This is Poland. Poland's one of the places that's actually got reasonable GDP growth today, about 3.5%. Similar sorts of investment opportunity, this in shopping centres. This to show a cash return, again, close to 12%. I'm getting quite excited by this because I've never seen these sorts of numbers in my working career. And I find that a really interesting place to start from. And finally, on page 9 is something that ironically comes out of the former Lehman portfolio in liquidation. The present owner, as we know, doesn't have money, has no ability to fund tenant incentives, tenant improvements that you need to do. Opportunity possibly to buy this to show a return of 11%. How do you see that? I've never, ever seen that sort of yield in central London. Now, there are issues surrounding this building, so it's unlike Tom's very prime. There are tenancy issues, short leases, all those risks are in there. But I've never seen that sort of yield before. That's the sort of opportunity that's starting to come in Europe. Banks have to unload their balance sheet. Borrowers are in default. They've got to do something. There is an opportunity. So I do paint a pretty negative picture. But what I also want to paint for you is one that I hope is realistic, but also one that incorporates opportunity. I think if you stick to fundamentals, stick exactly as Thomas said to those northern markets, I think there is enough opportunity in there. Think about cash, because I think it's a good thing. There's a severe lack of debt, and anyone who can offer that really has an opportunity to do something. I think, is there a risk there will be no euro? Of course there's a risk. I think we both think that the euro will survive in some way, shape or form. You're going to get a lot of machinations around this in the next period. But I do think the euro will survive because the consequences of it not surviving are too dramatic to even think about. So I think it remains. I think Germany will probably have to step up to the plate a little bit more and help it through. That's a tough call for German citizens, but they've been a beneficiary of a weak euro to date. So I do think it is, and I do think there are opportunities, providing they're looked at on a pretty selective, providing you look at them on a very selective basis, there will be opportunities to make some very interesting returns.
Any questions? Yeah.
I'd like to pose a couple questions. You talk about how things are constantly changing and that the risk is there because we don't know what's going to happen. Do you think that for a long-term investor, now is the time or is down the road a time? Is fear the best time to invest and get the return? And along those lines, is this the best way to play the opportunity? Or is working distressed debt out of the banks or elsewhere rather than the equity real estate possibly better? Good questions. We're equity investors, and so we tend to have a time horizon that's 12 to 24 months. History tell that most people are not great market timers. When you look for the bottom, you tend to miss the investment opportunity. But I think what both of us have been trying to describe, at least, is that if you make investments in good the underlying real estate is good, and you do that in part of the capital stack where you've created a sufficient buffer. And in Nick's examples, right, there's from 100 down to kind of 65 before your investment is at risk, right? So you have to see asset values decline, 35% from where we are today. I'm not going to tell you that I feel certain that values are not going to go down 35%, but for prime real estate, I think the likelihood of that happening over the next 12 to 24 or 5-year period of time, depending on what your time horizon is, relatively low. So I like, I'm an equity investor, right? So I'm at risk from $1. As a debt investor, you've got 35% of room before you start to have your first dollar at risk. And if you look at how those types of properties are covering, the cash flows covering the debt service, I feel really good about that, particularly for prime real estate. Now, the examples described here are more in the mezzanine piece, right? After the equity, you're the next lost piece, and then you're not the senior secured piece. I think that's a very good risk-adjusted return right now. But like both of us have described over the last half hour, the range of outcomes is very wide. But I think, again, as we both described, if you're in those northern European countries, I think there is some greater level of safety and ways that those governments can affect the outcomes. So it's hard.
I completely concur. It's very easy to say, yes, let's sit and wait. But as we know, the best cherries always go to he who arrives at the market soonest. The reality is...
That's not a very New York way of explaining things. I think I got it.
Sorry, that was an English expression, wasn't it? But the reality is, I think there are opportunities there, and I think if you're selective about how you look at them, I think there are some really interesting returns to be had. I wouldn't throw all the assets at it, I'd be selective. But I do think, if I look at where we have been putting out, we've been very overweight the US and very, very underweight Europe. I think our central thesis is to take a little bit of money off the US table and put it back to the European table as we start to exploit that opportunity set. We'll still, on a market weight, still be underweight, but on a relative basis we will have come up. And that's where I see the interesting thing. And I think when you get to a market that is clearly going to have issues in it, people get very risk averse. You will, as a result of that, see some real pricing anomalies come up, and that will throw up interesting opportunity for someone who is able to move relatively quickly. We all know that the best deals we ever do are the ones where we can show the seller, there's the money. If you want it, it's here, but that's my price. And you've got to be prepared to do that, and also be prepared to walk away. I think, don't do everything, because I think there are times to walk away as well, because I think that's what it's like at this point.
I'm just suggesting that consideration based on your page 3 chart, with all the property rolling into the seller's market over the next 3 to 4 years, that at least some kind of vintage year introduction of the investments may make sense, because your great deals today are probably going to get better. There's no way you can stop the chart.
There's no way I can stop the chart. You're absolutely 100%. But what I do think I will see, and I'm talking here in the US, I think you will see more international capital. We're seeing that today. We're seeing significant amounts of money come in to say, you take London as an example, more than 50% of the City of London today is now owned by overseas parties. It's the first time that's ever happened. So there is money certainly looking, whether you describe it as a safe haven or whatever else. I don't know how you describe my city at the moment, but that's how it's perceived. I can't stop that. That is definitely going to happen over a period of time. But I do think there will be money looking for opportunity.
So Bob, let me see if I can answer your pension fund perspective. So we're pretty slow. So legging is a good way to put this. We leg our way into everything. So we did invest in Blackstone. We do have several opportunities that think the managers that have people on the ground for debt equity conversion, real estate forum. We are working with it to provide senior loans to debt, because as they say, the banks are out. Senior loan is the safest. To the extent that it's the safest, most secure, big risk premium baked in there. There's a big risk premium baked in there. We're supposed to capture that. So we're trying to work our way over there. It takes us time, but this situation not going to get fixed overnight. Right? It's a multi-year opportunity that you do have to slowly work your way into, which is why we thought we'd bring these guys to talk about the opportunity. Certainly, in the public side, Martin finished an RFP for REITs, that included international REITs for the first time. So we're supposed to be checking a bunch of boxes to get some capital. But again, not getting the ranch, but moving in that direction.
Brookfield yesterday made an acquisition in the City of London. So one of your partners is finding an opportunity there where the seller happens to be another listed company but wants to focus on retail. So they're willing to sell their office properties at a reasonable price. And we talked about returns. I think that's a kind of 7 to 7.5%, some levered return, something like that. So that's a low double digits type of return. So there are opportunities that are out there.
Any more questions on European real estate? No. Great. Thanks. Thanks very much. Thank you.
Thank you.
Now, that's how you're going to see that. Pretty fast.
Yeah.
Tony, why don't you sit down?
No record today, Larry.
Yeah, sorry. I forgot this one. Lovely, nice thing.
What's that?
Yes, Anthony. Okay, there we go.
We're in the process of doing that. Some of them are in living color, some are not. I mean, that's
Passing to the law.
We're going to have a collision.
We got a collision.
Okay, we're ready.
Good morning. So I apologize in that the presentations, some are in color and some are black and white, so as you can see, we had a little technical difficulties. That being said, as you know, the Controller's Office is very involved with our various stakeholders in trying to streamline the procurement process so that it's more efficient for the various board of trustees, including fire, to be able to select managers where appropriate. I would like to introduce you to Tony DeLilio, who is our Agency Chief Contracting Officer, which is a very big, complicated title, but really comes down to, in a lot of ways, being our procurement expert here in the office. And as I mentioned, we're working with various stakeholders. And today you have before us a rule that we proposed before the... We proposed before the city's Procurement Policy Board, otherwise known as the PPB rule. The rule before you that we're proposing before the PPB rule would allow you to do two things. One, it would allow you to graduate managers under certain circumstances, and also would allow us to retain certain managers who performed well for the fund under certain conditions. I think Tony will get into the presentation and provide you the details, but what I want the board to know is the takeaway is with working with the boards, we'll pursue these changes at the PPB board, but anything that we ultimately would decide to do as having this added mechanism, we would then bring back to the board before we made any decisions. So this is a rule change that allows us to come back to you to pursue greater flexibility and in hiring our managers. Tony?
Good morning. I'm not sure that after Stan just went through all that, you really need me, but I'm just here to discuss a proposed amendment to the PPP rules. I'm not here to discuss how the boards will make decisions to avail themselves of the rule, but it's just an option that every city agency has to use this method when it meets the standards in the rule. Negotiated acquisition is a method of procurement that allows for negotiating directly with a vendor or several vendors without issuing a competitive solicitation. It is allowed under limited circumstances when there is a time-compelling need or a limited pool of providers, and where using a competitive method would not be feasible. It's not intended to replace traditional competitive methods. It's just merely an option that all city agencies have for all professional services and other goods and services, except in the context of investment managers. So we believe this is an anomaly in the rule, and that's why we're seeking to change it. So the current PPP rules currently prohibit the use of negotiated acquisition to procure investment management services, except in limited circumstances. With respect to the emerging manager program. So we're working with, as Thad indicated, we're working with the PPP and others to address this anomaly, to allow the use of negotiated acquisition in the same manner, under the same circumstances as the negotiated acquisition method is authorized for other professional services. So the amendment will provide the investment boards with an additional procurement tool to use when it deems appropriate. The benefit of this, one of the benefits of this is to allow for contract extensions, excuse me, of existing managers with good performance via the negotiated acquisition method when those contracts would otherwise expire and there's no current RFP or solicitation out on the street, or if it's not completed yet. So you would be in a position where you wouldn't have to end those contracts when all the renewals and all the other extensions have been used already. So it's just yet another procurement tool. Any questions on negotiated acquisition? That part? Township.
Would you also want to be able to use negotiated acquisition if there was a time-sensitive nature in the procurement? So, for example, if we had to terminate a manager and we thought that we couldn't give the money to an existing manager and there was no index fund in the toolbox, we also want to utilize negotiated acquisitions at that point?
Right, that would be one of the standards, is again, the time-sensitive circumstances that you have. In fact, you have to meet that standard.
Okay, so you're looking for contract extensions with a good manager, and then as a substitute for the new pilot process in the event that we need to expedite a procurement?
Yeah, I don't think we've ever considered this.
A simple answer is no.
Okay.
You can't avoid the procurement process.
Right.
So this is really tailor-made for a very special situation, which is we have managers, their contracts terminate. The way it's set up now, the only way to give that, to keep that manager is to start an entire RFP process, which sort of doesn't make a lot of sense. Hence, we should have some flexibility, which is this, which you use rarely. So if you have a manager, if he's fine, contract again, the answer is you can extra extension through this process so that you just keep the game going with that one manager. If you wanted to say, hey, we need some other stuff along the way, that's an RFP. Right? So it's really just to fix the anomaly of everything's fine, we just don't have the time or the people to crank up an entire RFP process. So that's what this is designed to do.
Or the decision hasn't been made. I mean, you know,
yeah, we haven't decided.
This is a fail-safe for all, for all city agencies and as well as this board to avail itself of when decisions just aren't made in a timely manner, as many things interfere with decision-making.
It's a very specific George with very specific property.
Okay.
So the second page is related to specifically the Emerging Manager Program. So these amendments are also meant to clarify and streamline aspects of the current rule as it applies to the Emerging Manager Program in order to increase efficiency and efficacy of the rules in fostering the program while maintaining appropriate control so that the sub-managers could graduate into direct contracts. These changes make the PPP rules consistent with the original intent of the Emerging Manager Program and the Retirement Systems Board of Trustees guidelines to enable sub-managers to enter into direct contracts with the controller on behalf of the systems. Once their assets under management grow too large to justify the extra expense of managing assets to a manager-manager structure. So one of the benefit, as I just said, clarifies the use of negotiated acquisition. Right now, it is unclear as to when those sub-managers can actually graduate. The way the rule is written contemplates termination of a contract of the manager and managers, which was not really the intent of the rule. So it's just very unclear. This will clarify that negotiated acquisition would be the appropriate method to graduate a sub-manager and continue with your manager of managers for the other sub-managers that they are engaged with. So this will allow the boards to then decide that they want to continue with the sub-managers' assets are now larger and can get a direct contract with. Any questions?
And this is only for the Emerging Managers Program, so not any other fund-to-funds program we might have?
As currently written, that's correct. I believe that it is limited to the Emerging Manager Program. That's how the current rule is, and where the amendments are for that program.
And do we want to see the ability to graduate a manager out of any fund-to-funds? Why are we limiting it to an Emerging Manager Fund-to-funds?
We don't have any other funds.
Yeah, I will also tell you, I think Tony made a very good point.
We can attract.
I didn't hear you.
She said hedge fund of funds. And I said, we have the ability to contract directly with hedge funds. It's just managers and public security. But again, it's the DPP rule.
Yeah, I would also say, Larry, I think Tony made a very good point. If you read the rule, it really is an amendment to an original rule maybe 10, 12 years ago for emerging managers. So it's really an amendment of an existing piece. So it's sort of limited in that respect.
So these are two nuances of little things that we're trying to clean up to make our ability to deal with real-life events that happen in real time as opposed to not be able to deal with things. So the controller's office will be working with the mayor's office, the PPP, to get this. Boards don't have to do anything, right? Correct. We're more of an update.
Exactly.
And do you plan to come back to the boards with a proposed process, an expedited process for the boards to approve?
No.
So no process at all? Just doing acquisition however?
No. This is just these two little amendments.
Right, so what would the process be? So if you're proposing this change to
There's an
do it-
advantage as a manager with the back of the board.
Right, so what would the process be that you would use to say that a manager is still a good manager, for example? So you're saying we want to...
We're not going to, let me just be clear. This is a rule change. There's no action at all on any manager.
Right.
So whatever actions we would take to hire or fire managers, the same we always do.
Sure.
There would be a memo, right, if we're going to recommend a new manager in this case. There would be a full memo. You'd have everything you always get in every other memo that we get.
Okay,
And the board can choose to do it or not do it.
so there would be a memo from staff, there would be a memo from consultants. Okay.
All the same.
Everything's sent always.
And at some point, can we talk about those memos, maybe in executive session? Just to make sure that, I understand we're not approving anything today, this is an informational update, and thank you, actually think this is a good thing that you're doing, so this is great. But I think we do want to talk about some sort of standardization of what we're receiving in terms of recommendations from consultants and staff, especially in light of this expanded new development, which I think is a good one.
Just a question on the mechanics. Who ultimately decides whether this amendment will go through? Who has to decide, and how long do you think it would take?
The procurement policy board will make that decision. They will have to promulgate the rule. There's a process in the City Administrative Procedure Act which covers rulemaking by the city. Let's go through the CAPA process. There's a 30-day comment period for public.
Who's on the PPP?
Who's on it now? Let's see. Current composition, there's one person missing, I believe.
I think, Tony, the broader question is, it's a 3-2, right? It's, generally speaking, I think that's, I don't think Doug wants to know necessarily who's on it, but what's the general composition?
There are 2 controller appointees and 3 mayor.
2 controllers and 1 mayor.
3 mayor.
2 or 3.
So they would decide whether the rule will get changed.
Timing?
I don't know. We had expected a meeting in June. June is almost over. I don't know. We're trying to find out. We have decided. The mayor's office of contract services, so the staff of the PPP right now. So it's up to them. They have a world of forms going on, so we understand that.
This year?
My fingers are crossed. I hope so. We really hope so. We're asking consistently. Any other questions?
Okay?
All right?
Right.
Thank you.
Thank you.
Thanks. All right, so that ends the public agenda of the
We need a motion to move out of the public session and adjourn the meeting.
So moved.
Any objections?
Second.
Hearing none, the motion carries. We'll start with firefighter variable supplement. We need a roll call, trustees.
Mr. James Levin,
Present.
Mr. Robert Straub.
Present.
We can start the meeting. We have a quorum. Public session?
Yes, so the only item on the agenda is the quarterly report for the quarter ending March. Larry already went through the basic items about what went on in the quarter ending March, which obviously are the same economically for the VSF. The only difference is, of course, for the VSF. The only difference, of course, is that the VSF pays an annual benefit. If you turn to page 3, you'll see that the fund, as of March 31st, had a $418 million total assets. The return was strong on an absolute basis, 8.99, just shy of 9%, 7 basis points behind the benchmark. And similar to the pension funds, you'll see the 3-year number is very high because the bad quarter of December rolled off, but it's still in the 5-year number, and that's why it drops down. We are ahead of the benchmark for those longer-term periods. The asset allocation is shown on page 4, and this is different from the regular pension fund in that we do not have real estate, private equity, and other illiquid asset classes because we have liquidity needs every year on December 15th. And we are very close to the rebalancing ranges. The bars look large, but that's a function of the scale of the chart. The attribution is on starting on page 5, going through page 7 for the quarter, 1 year, and 3 years. The fund is generally fairly simply constructed for the entire U.S. equity portion, or the 50% allocation for U.S. equity. It's entirely passively managed. You see the total equity allocation on page 10. I'm a New Yorker, I'm sorry. The total equity allocation is shown on page 10, and that's dominated in green by the U.S. equity, which is entirely passively managed, as you see on the next page. Just over half the portfolio is in this Russell 3000 index portfolio, and as expected, the returns and risk closely match that of the underlying index. For IFA, Thornburg is the manager, single manager. It's about 11% of the total funds. The returns for the quarter were very strong. As Larry mentioned, that world has moved on. The fiscal year to date 12-month numbers are still negative, but the 3-year number is strongly positive. The 3-year number is strongly positive. Emerging markets is managed by State Street, and the returns are behind the benchmark, but positive for the 3-month period, as well as for the fiscal year to date and the longer-term periods as well. And that represents 4% of the overall assets. The only other equity exposure would be REITs. Morgan Stanley is the manager, and they've done well on an absolute and relative basis. And I want to point out the 3-year number, which is the strongest of all of the asset classes, returning well over 40% and beating the benchmark. Since inception, however, you see it drops off, and that's because in 2008, REITs had a strongly negative number. But since inception, the returns are over 200 basis points ahead, which has helped giving the overall return to become 475. For fixed income, on page 16, we have a pie chart that shows just about 30%, policies 30% to be in fixed income. We're at 29% as of March 31st. And just about 2/3 was in the investment grade 4+5. Same situation that we had in the larger fund. We're underweight the Treasury agency government sector, and we're overweight the other sectors. Each of the managers, Treasury agency is PIMCO, mortgages PIMCO as well, and credit is Kaplan Canada. Each beat their benchmark. And the total returns for the program, which is 19% of the fund, is on page 18. And the returns on an absolute basis are strong and are at or near the benchmark. Or in the case of 3 years, we're well ahead. In the case of the 1-year number, we're 84 basis points behind. TIPS is on page 19. PIMCO is the manager, and the results have improved. You remember they were underperforming over the last few quarters. That's changed. They're now outperforming, and the returns on an absolute basis are strong. High yield on the next page is 6%, and we've just done a selection for a new manager. And we'll be seeing those numbers for that manager in the appendix going forward, but the program results are shown on page 20. Are there any questions?
managers to perform equal to the index, or do we expect some premium of return over?
It depends on the manager. If it's an active manager, they do.
Okay. Do we ever show that to the board anywhere? I just realized that we're not seeing
When we-
what the manager, what our expectations are for each of our managers.
They are not in this report.
So when does the board ever see that? When does the board ever monitor our managers versus their individual benchmarks?
It's in the appendix, but versus in other words, each of the individual manager returns versus the benchmark are in the appendix.
With their individual benchmarks, not the public.
With the individual benchmarks are in the appendix.
So for example, which manager has an alpha expectation?
All of the active managers. So every manager except for the passive U.S. equity manager.
And so what is the alpha expectation for each manager? I'm trying to see how much we're looking for them to outperform.
They would be different.
Just in the pension fund, we have in the guidelines for each manager what the alpha expectation is by manager, and it's different it's similar for each class of manager
And style of the manager.
So have we ever reported to the board whether the managers are meeting their individual performance benchmarks?
We have reported to the board after the initial selection of the manager. This is what we reported.
Okay. Is there some reason that the board isn't able to see the manager's performance versus their individual manager benchmarks? I mean, I've seen reports in the past.
You're talking about not the performance versus the individual benchmarks. So that is here. You're talking about versus the expected alpha over the benchmark.
Not on a monthly basis, but when we come to you with a recommendation to terminate a manager, we show you that.
Okay, but shouldn't we, as a board, be seeing that periodically before we get to the point where a manager is being terminated?
If the board wishes to do that, we will set something up.
Is it difficult to provide?
It doesn't make so much sense doing it monthly or quarterly. I mean, perhaps on a 3-year, 5-year basis.
Should look at it. I agree. Monthly performance, and even quarterly. I think it's too much.
So perhaps a
But at
chart.
least annually.
So perhaps a chart showing what the expected return is in the benchmark. Would that suffice?
I thought we could do it on a yearly basis.
Yeah, I think at least annually the board ought to be able to see which managers are actually
So a report.
outperforming and underperforming on their benchmark.
And in our guidelines, we generally talk about a market cycle. So, which is usually 3 to 5 years, depends on the market, sometimes 3 to 5 weeks, given what's going on in the market, but generally 3 to 5 years is what we refer to in the guidelines.
Yeah, I think we should, and I've seen that, not with this board, but I've seen it from consultants and from other providers.
So is that something that the board is interested in seeing?
And what would be the appropriate month, December or January?
Well, it would be, we could report it at any time period, but we would go over, like as Seema mentioned, 1-month number, a 3-month number, or even 1-year number, but we would show, say, a 3-year or a 5-year, which covers a market.
I understand. What month would you do the reporting?
Yeah, we would only get the data late, right? So it would be February to get
February, okay.
Yeah, so if you want to do it as
What
part
do
of
we agree on an annual
if you want to do it as part of the
report in
annual,
February?
if you want to do it on a fiscal year basis, calendar year basis, up to you.
What do you suggest, 3 to
Well, the
5?
managers do it on a calendar.
Right, we're the only ones who care about fiscal year. Managers do it on a calendar year, that's true. So we can come after the new calendar year, whether it's February
February
or
give you
March.
enough time to do it?
We'll find out. Because there are a lot of managers. There are a lot of managers, and each manager has a different number built into their expectations. VSFs obviously have only a few managers, but the overall fund has lots of managers.
May I suggest that if this is something the board wants to consider having the Bureau of Asset Management prepare, that you might want to think in terms of a more robust kind of report that addresses not only the expected alpha for each manager, but the issue of converting from gross returns to net returns, and try to deal with it as a collective, where do the managers stand vis-a-vis the expectations made upon them when they were hired. And it's a lot of work. And so you shouldn't ask them to, when you attack some of these things piecemeal, I'm not sure you see the whole picture. And yet, trying to do it holistically is not a trivial exercise. So even if they were to start by just giving you a list of the, over a period of time, alphas, and similar to the back of the book today, the average expenses per manager, I mean, you've got a fair amount of information available. But if you're going to have a report or ask that this be done, I'd encourage that you give the Bureau of Asset Management a chance to think about it and then see about how to make a more global report on the status of managers relative to all the issues. And if that's not practical, that you come back and say and try to come up with something that's within the ability to do the work and yet get the information. It's because this is not a trivial, one manager at a time, everything's easy. Doing it across your tremendous number of managers isn't. And also, it's only one part of the picture. I make a presumption that every single manager has an alpha greater than their expenses. Okay? Otherwise, you should be passive. So, but then going from there and exactly what it is an entire discussion. And if you want to do it only once a year, that's great, but I think you ought to look at it holistically, and you ought to give them the opportunity to figure out how best to do it without spending all the resources on coming up with the information. So,
Yeah, Bob, you're right. To do a net of fee number is going to take a lot of work. To get all of that across all the managers, with the right number of expenses. That's more.
yeah, and yet it's very important for those performance-based managers who then proceed to underperform the index and get big performance fees because of the timing of how things work and so on. And in the end, that's an important, essential part of evaluating them. But it's not trivial. So I think the question originally raised is, you expect things out of your active managers, some of which is not obvious from the reported information. But exactly how to get to where it's useful policy level or strategy level information for a board to deal with rather than techie stuff, I really think just requires a lot of thinking, and you ought to, if you really want it, you should think about letting the Bureau of Asset Management consider how best to address the multiple questions of how much alpha, how you deal with expenses, how you come up with a judgmental process on managers beyond and above what, in fact, I've seen this stuff before. She does all this when you terminate somebody. The question becomes, is there something that can find something useful before you get to that point? That's not easy. She does whole big reports to figure it out. So, as I say, I just suggest maybe if it's something the board should see, that it be something that be bigger, but also be within the reasonable capabilities of producing, given all the other agenda items that exist.
And I agree, and that's a very good suggestion, because I'm not sure how useful looking at monthly performance really is. And we do spend time doing it at every board meeting. But perhaps we can think of maybe an annual deep dive that talks about the important things that a board really should look at. And Doug, maybe you can help as well, working with BAM, to figure out what boards should be looking at on an annual basis. What are the really important things that we should be monitoring instead of, month by month, we're up, we're down, we're up, we're down. Of course, we're going to be up and down on a monthly basis, but let's think holistically to Bob's point, which is a great one, about what our sort of annual performance review ought to be.
And I'd probably go even further. I'm not so sure the performance of individual managers at all is something the board should look at, other than to be brought the information that the original decisions on certain managers that didn't work out, and the staff ought to be hiring and firing the people that if you you want to be inactive because there's justification and the case is made, you ought to delegate the authority. So there's a limit to how much detail you should get at this board, because I really believe you should be focused on policy. And policy is what level of risk to take with a fund, which is set forth in the kind of asset allocation, justifying it, and focusing your energies there, and allowing a lot of this, what I consider the noise, to be carried out by people who are professional and are very capable of doing it. And you could have shorter meetings.
Never need
I don't know what else
lunch. You would never
to say.
need lunch under this proposal.
And you put the responsibilities where they belong. The board sets the policy, and you delegate to the Bureau of Asset Management to carry them out, and then you measure they're doing so. But, you know, I always have to give this speech about once a year, once a month, or whatever, and sorry.
Well, it seems like we need a process, though. That's what we were talking about, and it sounds like most people are in agreement we need some kind of report card. The frequency is a little unclear, and what the elements that go into it. Sounds to me like that's what we're talking about. Would it be, should maybe the Bureau of Asset Management come back to us next month thinking about this issue and what they think they can provide and what frequency and what elements? Is that enough time?
Not do it next month. Next month is...
Oh, next month, I don't
I think it doesn't, I mean, this is something that we want to do for the long term, so I don't think we need to rush into anything, but I think it's all valuable. In the next, over the summer, maybe?
What do you suggest, Larry?
Well, you touched on about 12 different topics, starting corporate governance. I mean, board governance 101. So, I guess if you want, we can have a whole conversation about that. Have an agenda item on that if the board wants to. I don't know what you guys want to have a
I think
conversation
Bob
on that.
summarized it very eloquently, and I think I would trust it to Pam's judgment.
Okay, so the ball's in our court, we'll come back to something like that. I'm not quite sure what the question was, but we'll read the transcript again and come back to respond to it. I know next month we have an awful long agenda because it's in the fiscal year. Annual plans, probably. But let us have some offline conversation with people and see what's what.
All right, then. So, is that it for this
For the firefighters, yes.
Okay,
Unless
so-
there are any other questions.
Anything else?
The fire officer.
Okay. So now we need a motion to move out of the public session and adjourn the firefighters variable supplement fund and start the fire officers variable supplement fund.
So moved.
Second.
Any objections here? No objections. Motion passes.
So the same background...
Wait.
Oh, sorry.
Lovely move.
We're in the public session of the Fire Officers Variable Supplement Fund. Ms. Ranjit Nagaswamy
James Emery has Ms. Nagaswamy's proxy.
and Mr. Larry Strauss.
No president.
Mr. James McGowan,
Yeah.
Mr. John Dunn.
Yeah.
We have the full votes and a quorum. We can start the meeting.
All right, so now I will start. The economic background...
I'd like to make a motion that we accept the report as provided, and we're good with it, we've reviewed it, and we can move on.
I second it.
Any objection? Hearing none, the motion passes.
Thank you.
We found you through the trial.
We now need to move to, a motion to move into executive session.
No, we have to adjourn this meeting first.
Oh, we got to go through it. Okay, we need a motion to adjourn the fire officers variable supplement meeting.
I make a motion to adjourn.
And a motion, and to resume the fire department's pension fund meeting. Same part of the motion.
I second the motion.
Okay, any objections? Hearing none, motion carries. Now we need a roll call, right?
Now we need a motion to move into to the
That's right, we did
executive
it all.
session.
We did, I'm
of
sorry.
the
Thank God I have the
Executive session.
motion to move to executive session.
So move.
Second? Any objections? Hearing none, motion carries.
The roll call remains the same, and we're in the executive session.
Are the cameras on?
We will get them all.